Hi, everyone. Thank you very much for joining us. For those who have been to one of these before, welcome back. And if you haven't beforehand, well, it's good to have you. I'm Al Reid, and before I hand over to Lance and Hugh, just a few housekeeping things. We've muted the microphones and block cameras just to limit the background noise and distraction, but you can use the Q&A function at any time to ask a question, and I'd encourage you to do so. We'll come to them at the end of the session, and I'll ask them on your behalf after the formal presentation. Also, if there is a click button at the bottom of the screen saying sync to presenter, please click this. So over now to Lance and Hugh.
Thanks, Al. Thank you for joining us, Hugh. Thank you for joining us. It feels like the quarterly's just come around really quickly. So for this quarter, the topic Beyond the Noise, hopefully our attendees have a lot more context on that phrase at the end of today's session. Now, I'm also conscious that a number of attendees today are familiar with us as a strategy and as a house. But before we begin, and for those who aren't, a couple of key things to call out. So we have an alternative approach to global equity investing, and importantly, we deliver three distinct outcomes. Returns from a differentiated source, really strong ratio between both upside and downside capture, and significantly lower volatility than the broader market. And of course, we're really excited that we're not that far off a 20-year track record, which for us is ultimately the evidence and the body of evidence that supports our ability to deliver on those three outcomes. So that's a good starting point. Now, if we refer to the investment team's recently published quarterly, the phrase flooding the zone, which I think was a media strategy, a strategy designed to flood the public with a deluge of information, having the effect of being confusing and disorientating. If I think about markets in the last quarter, it certainly feels appropriate to make that comparison. And I think the manifestation of that was, whilst it may have reduced recently at the start of the quarter, volatility rising above 50 for only the third time this century. Now, again, on the quarterly, it was something that really stood out to me and perhaps defines the topic for today being Beyond the Noise, was this statement. So Hugh, forgive me for reading out effectively the work already produced. But one item that's so strong here is that the statement of, we believe this is the end of the golden era in which nominal cash flow growth and the cost of funding diverge to drive up the price of a broad range of assets. So we'll dig into that in a bit more detail. And perhaps a good way to step away from the noise is to start at 1800. so yeah, a reasonable step back, and noting that step back to 1800, would you be so kind perhaps to take us through what we're looking at?
Yeah, absolutely, Lance. Thank you. So this exhibit here that we're showing is really the current account balance globally back to 1800. So it's really divided up between regions. We've just broad brush. You can see that the yellow is the US, the teal is Europe, and the dark blue is, the rest of the world. We actually have the aggregate data by country, but that's what we're showing here. And you can see that has ebbed and flowed over, the last 225 years. We've also mapped across that the different monetary regime. So that's really how the current account and the cash has moved around the world. And I think there's also the uses and sources of that cash changing as well. So, for example, if you look up into, effectively the early 1930s, the end of the classical gold standard, broadly outside of World War I, Europe had a huge current account surplus. It's where the majority of the world's manufacturing and goods and services were produced. And of course, they were putting out that capital into the rest of the world and the US, who had a deficit of manufacturing capacity, infrastructure, roads, and all that kind of good stuff. Okay, so this was productive investment, cash going from one reason to another, where they were short of many of the goods and services that, well-functioning economies and societies require. And you can see that really the quarterly is highlighting our view that since the early 1990s, so 1994, that you had this, what we've termed era of globalization. So to contextualize that, you had Eastern Europe, obviously the fall of the Berlin Wall and 350 million potential consumers coming into the labor force, but also the global economy in terms of Eastern Europe and the former USSR. And of course, in that period in 1994, you had a very famous speech by Deng Xiaoping in China, talking about prosperity in and of itself being something that had an inherent positivity about it. And effectively, China and many regions in that part of the world coming into the global economy as well. I think it's easy to forget the World Trade Organization only started in 1995.
Yeah.
So we're really marking that as a distinct moment in this monetary regime that's always ebbed and flowed, as you can see on this exhibit. We've had different arrangements for how global capital has moved around the world. And we've name-checked them there, classical gold standard, Bretton Woods, the managed floating exchange rate period, and so on that we talked about. And that facilitated a huge amount of capital accruing to the rest of the world and to Europe, in effect, in terms of that current account surplus. And that was effectively put in or lent to the US, where you can see they have run a persistent and sizable current account deficit right through that period. Now, I would highlight that over that period, fixed asset investment in the US has gone down. Okay. So this has not been capital going to the US to increase ultimately productivity and the manufacturing footprint. This is ultimately capital that's been consumed by the US. Arguably one could say that they've enjoyed a greater standard of living than all else equal should have accrued to them because of those capital flows. So that's just to contextualize that, and the quarterly really is focused on that, and I think we're going to come on to that today. But that we've been living in a period since 1994 until 2016 to today, which we think has had huge implications for both asset markets, but also for global economies and the makeup of individual countries and regions. And that is starting to be coming to an end. And we're trying to negotiate globally a move to the next monetary regime.
Sure. Well, thinking about, I suppose, the transition, which we'll dig into in a little more detail, maybe a good place to zoom in there is to think about first principles of investing. I suppose what does that mean?
Yeah,
As first principles.
Yeah, why should we care?
Yeah.
I mean, at the end of the day, we're all one way or another allocating other people's savings and capital. And the reason that we think this is important in a practical sense for savers everywhere is in a very first principles approach, and this is what we're showing on the exhibit here, is that if you know the required return that you want from an asset, so you've got a return objective, and you know with perfect certainty the nominal cash flows that come off that asset and the cost of finance associated with purchasing that asset, then you know precisely the price to pay in order to receive that return. Now, clearly, the world is a lot more uncertain on that, but in terms of nominal cash flow growth and what happens long term, also kind of finance moves around. But in essence, if you know the nominal cash flow growth off an asset, you know the cost of finance, you know exactly the price to pay to give you different returns. It's really that simple. And what we've just shown in the previous slide is with the end of this regime, that is going to have implications potentially both for the nominal cash flow growth that comes off all assets and the nominal cost of finance that potentially will be associated with those assets, both going forward, but also what's been the experience of all investors since 1994 to 2020.
Sure. Well, let's dig into that if we could in a little more detail. So thinking about these two sort of highlighted bars, investors have certainly benefited over that period of time.
100%. So let's take ourselves back to 1994, if you will, and imagine that we were sitting here and thinking about building a portfolio or buying a equity. We would have a expectation or a forecast about the nominal cash flow growth that will come off that asset over the next 30 years. And of course, we would have an assumption about the cost of finance.
Sure.
And what this exhibit is showing you is the dark blue line is that nominal cash flow growth has simply gone up and up and up. Okay, we would have underestimated the nominal cash flow growth that came off whatever asset we were looking at. And the reason that we would have underestimated that is really twofold and associated with this era of globalization. The first of that is that ultimately in a globalized world where you have, a tremendous influx of labor into the global economy, that actually the cost of production has fallen in 8 of the 11 sectors globally. So this isn't just a function of, technology, for example, or a single sector driving that nominal cash flow growth higher. It is a function of that era of globalization, meaning that the gross margin in 8 out of 11 sectors, so, per unit of sales, the associated cost of manufacture has just fallen. And that's really that era of globalization. That's partly that labor and, the re-engineering of global supply chains into low-cost regions has afforded that. And then secondly, of course, you've actually had a tremendous amount of new consumers that you can sell to. So actually the nominal top-line growth, all else equal, has been better because the addressable markets have increased in aggregate globally. And so we would have underestimated the nominal cash flow growth, and therefore the price that we were prepared to pay in 1994 to get the required return that we've identified, so we want 10% per annum, we would have underestimated the amount of cash flow growth, and therefore underestimated the price that we would have been able to pay to get that return for those assets. Equally, what we're showing here in the teal line, until very recently, really at the start of 2022, is that we would have overestimated the cost of finance. So if you think back to that first exhibit that you showed, Lance, that was really this recycling of, the current account surpluses from Europe and the rest of the world back into particularly the US, which obviously is the dominant kind of market in terms of setting cost of finance, that actually pushed down the cost of finance. And of course, with this move to lower cost of manufacture across 8 of 11 sectors, it meant in aggregate, you were getting disinflationary forces in this era of globalization. So that helped the teal line be lower than we would have anticipated in 1994. So in effect, at a very simple level, at that first principles, if we were building our DCF, we would have underestimated the nominal cash flow growth and we would have overestimated the cost of finance. And that has had really positive implications for asset owners of all asset classes.
Yeah, well, I was about to ask that kind of trajectory, that positive jaws that you referred to.
Positive jaws.
The outcome.
Exactly. Okay, so this is what that has meant, which is, and we've just taken 3 different asset classes here: equities, real estate, and also high yield bonds. And you can see that the price appreciation in terms of where we are today, or the average over the last 10 years compared to the average over the 30 years, has simply gone up. And that is rightfully so in an environment where the nominal cash flow growth was underestimated and the cost of finance was overestimated. The all else equal, the valuation should go up. Okay?
Yes.
To get that required rate of return. And that indeed is what has happened. Now, the key message that you highlighted at the very start is that we believe that that is now at an end. We don't think that that positive divergence will continue. It could reverse, but it's enough to not continue to widen, to have significant implications for investors and private savers of all types. Because one of the clear outcomes of this over the course of the last 30 years, apart from just holding and owning assets, has been a positive experience. As long as you could hold them, you've just benefited from rising valuations to today's levels, whichever asset class you're in. But that crucially, there is a lot of market participants, people allocating capital or making investment decisions, where we have seen a reduction in the role of valuation and asset valuation is playing in the decisions that people make. And that is simply because assets have been rising in valuation, as we've shown.
Yeah.
Now, the point we make in the quarterly, and I feel quite strongly, is that it's wrong to take away that the importance of valuation is less and less. I think what people should be saying is, why did that happen? And are the preconditions that allowed that to happen over the last 30 years still in place? And what we're going to talk about and what we discuss in the quarterly is that we think there is a change occurring that mean the preconditions of that positive jaws that you showed are no longer likely to continue to widen.
Well, maybe that's a great segue to dig into some of those structural imbalances if we could. Perhaps a good place to start on the debt side.
Yeah, I mean, several people have asked us subsequent to the quarterly being published, and I think you were sort of relaying some of those questions. Why is this an issue now? Like, we could have been talking that positive jaws we could have shown that chart 5 years ago,
sure,
10 years ago, and of course it continued to go wider. Why is it now? Well, the era of globalization had many positive impacts outside of asset valuation going up. We talked about this disinflation, so a whole range of goods and services in real terms getting cheaper for us as consumers around the world, which is great. A lot of people obviously have benefited from prosperity around the world, so rising living standards. The number of people who've come out of poverty has probably never been greater in history. So, it's easy to be pessimistic about a lot of things happening in the world. That is a real positive benefit, that in aggregate, there's a lot less people in poverty, for example, mobility and so on. But alongside these real positives of this era of globalization, there's been rising structural imbalances that have also been allowed to occur because of this era of globalization. And you're showing two of them here. The first is actually because of this falling cost of finance and interest rates, actually the absolute level of debt has never been greater in history. Now, I think that's important to emphasize because obviously a lot of people have the private sector savings pool has gone up and up. There's a sense of like, well, my mum's not in a whole lot of debt, and in aggregate private sector wealth in Italy has gone up, and they're doing very well. It's easy to forget in aggregate though, the total amount of debt in the world has gone up. We're at the highest level ever. We're just showing here on the exhibit on the left-hand side, that teal, that's just the US. But this is equally true, of course, if you looked at China or France or Italy or, Australia and so on, okay? Different magnitudes, order of magnitude, but the absolute level of debt has been allowed to explode. And that's really because of these falling kind of interest charges. That is not something in perpetuity that can continue. The second key thing and directly linked to that is thinking back to that current account deficit or surplus, this recycling of capital. And you can see on the right-hand side, outside of two recessions, the US has never been running as big a fiscal deficit as we've seen, the annual rate, and that's just set to increase given what we've seen in terms of the big, beautiful bill. Yeah. So that's really about the US having to be financed by the rest of the world's private savers. So this is not other governments funding the US fiscal deficit by buying their bonds. This is private sector savings. This is all our clients and friends and ourselves in terms of people to the tune of $2 trillion nearly last year that required private sector savings to be put into the US. So they've actually been selling off assets in effect to the rest of the world. So that is obviously what's facilitated this rise of debt or allowed it to continue to perpetuate each year. So that's a second big structural imbalance. I think the third, thanks very much, the exhibit here, is that there's really a misalignment that's gone on with the global manufacturing footprint. I found this slide really endlessly, very engaging, I have to say, in the quarterly. It just shows from what happened in 1994 to 2024, that realignment of the global manufacturing footprint.
Yes.
You can see the loss of the global manufacturing footprint in terms of global share out of the US, but very pronounced out of Japan. You can also see Germany's kind of ownership, as it were, of the global manufacturing base has halved over that period. And the incredible rise in the global reliance on China for a whole range of everyday items in manufacturing terms, and some that are very strategic in nature. So that's a huge structural shift. And I think there was a recognition that that had some strategic implications for regions and countries, and that was becoming part of the political discourse really back to about, we're getting on to 2015-16 now, and of course the Biden administration just accelerated that. We've seen an acceleration again in the change in US administration, but also I think COVID, Lance, showed this long era of very thin and narrow supply chains. There was a recognition that left companies also vulnerable strategically.
Yes.
The sort of fairly classic story of, BMW not being able to get a washer from their single supplier in Bulgaria, so they can't put out, any 3 Series BMWs because they can't get the windscreen wipers on. There's a recognition, hey, we need to get diversity of supply, local champions as well, rather than just very long and narrow supply chains. So that's a third key structural imbalance that's been allowed to grow.
Right.
In a whole range of different industries.
What if we take just these, because they're all imbalances, let's go back maybe to those 3 components of valuation and perhaps plug them in. So how would you summarise their interaction with these points of valuation?
Sure. Just before I answer that, though, I'm not sure that I fully answered the why now, because those 3 things, you can see the debt, when we showed the debt was going up, the manufacturing footprint was changing 5 years ago, right? 10 years ago. One thing that we've jumped over and is really where the rubber hits the road about why now is, of course, that we're seeing, we've shown that the benefits to asset owners of all types has been tremendous. It's those positive jaws.
Yes.
But of course, it's also really come at the expense to labour in many regions in the world. So what we've seen is a really pronounced increase in inequality all around the world. And that has really left its mark in terms of a rise of populism politically. So, you think about what's happening in Amsterdam and Holland generally in the recent elections, France, obviously Hungary, Poland, but also, the most obvious would be the kind of changed political landscape in the US as well, in terms of that real bifurcation and populism and, the change of both administrations that we've seen over the last 2 election cycles has just really accelerated that. And that has spoken directly to the electorate about some of these imbalances. And that is why the first 3 are economic strategic.
Yep.
But the real moment that's catalyzing this negotiation or this reaching for a change in the monetary system, a fight for capital, if you will, is this era of deglobalization that's taken hold. And that's really the political decision above the economic. So I think that's why now, and we're seeing clearly in different administration policies and government policies in regions and in countries around the world, so this isn't just the US, that is speaking explicitly to a different place than that era of globalization. That's why now. And we're seeing concrete steps, policy proposals and policies that are being enacted by governments around the world that are much more interested in their own national or regional interests rather than from a globalist perspective. And that's what's happening right now. And that's why now we're likely to see a change on that jaws going forward.
The catalyst of when a tailwind becomes a headwind. Right?
Yeah, I mean, it doesn't take anything more than just an ebb tide. I mean, we could sit here and sort of be pessimistic about a real gale or a tide going out now. But even if it's ebb tide, if you think about, the US equity market has been, obviously particularly strong over the last sort of 15-year period, 15, 20 years. It's done about over 10% per annum, very strong kind of returns, reliant on exiting at this higher valuation if you're selling today. Now, if you just had the 20-year average kind of valuation, rather than that 10% plus return, you would have got about 7.3. So, that's in a period where you've had lower interest charges, tax cuts, lower depreciation because they have been underinvesting developed market equities relative to historic levels. So they've been all great positives. So let's say that there is an ebb tide now and we don't go anywhere going forward on the valuation jaws, all else equal, you would have got 7.3, and go forward, if you get all of those things again, you would have got 7.3. So let's say there's a small headwind. Well, suddenly you're getting down into numbers that, align actually with kind of long-term forecasts, frankly, but, are much lower than people have been used to, and potentially not enough in real terms to continue to be able to grow your wealth. That's really what we're talking about. So this is the rubber hitting the road. The required return's the same, assuming that we all want to live the same, or, we haven't changed that. But suddenly that nominal cash flow growth, well, if you're reshoring, energy transition, if you're no longer getting a benefit from cheaper and cheaper labour, that's demographically come to an end, but equally you're starting to limit immigration, you're starting to put manufacturing in relatively higher cost, not lower cost regions, which you have been doing, then clearly that means that the gross margin is unlikely to expand further, at the very least, and quite arguably would actually go up in all else equal, in which case your nominal cash flow growth sat here today, that's maybe forecast or embedded into some valuations, is going to be lower going forward, and that's really where you get the slack tide or headwind. And on the flip side of that, the funding cost, we showed that it's already risen. But of course, if there's a reduction in that current account balance and that flow of capital around the world, then all else equal, that means that the cost of finance, particularly in the US, would go up. So remember, I talked about the requirement for $2 trillion to go into the US every year to support the bond market, the currency, and the equity market in perpetuity, whereas we know that certain governments around the world in certain regions are targeting policies to retain more of that private sector savings to advance their own agendas. And probably the easiest and most intuitive is, clearly there has been a change in or a recognition that there will need to be more defence spending in Europe or the UK. They're talking about 5% of GDP. Well, that is going to be funded. It'll be funded by the population. And so the 370 billion of private sector savings that went into US assets out of Europe last year will be lower. So where does that 2 trillion come from? Where governments are starting to say, hey, we want that to be retained increasingly in regions in the European Union, for example. And we've seen that from the Future Fund, the change of mandate, obviously shared that with a number of people. We've seen that as well in the UK, where they're sort of targeting the savings industry. Must have at least 10% of their assets into UK companies, listed or unlisted. They're proposals, but they are pushing the savings industry to adopt that as a target. So all of those things are really a fight for capital. And that's really the structural element of this idea around trade wars. It's actually a fight for the capital, and that's why we started with that first exhibit. So that has an implication that the cost of funding is, we've seen it rise fairly sharply recently. Yeah. But in real terms, you could see that it's still quite low in all else equal. And therefore, you could expect potentially that will also rise. So there is the setup here, point to point over a long period of time, that actually both of those things are acting against valuations.
Yes. Well, a good next step then is to think about valuations. We talked about investors being in various markets, all having benefited from the setup. But perhaps this slide talks to the challenge for the new dollar. Yeah. The new investment portfolio being constructed, the new allocation tilt or weighting that an attendee on today's call might be thinking about. How would you describe the setup for that new arrival, the teal dot, if you will?
Sure. So I find that easy, just big picture, step back, listen, of the percentage of household worth allocated to equities has never been higher in history. Okay, so people who in aggregate own more equities than they ever have as a percentage of their total wealth. They own that in the greatest concentration in a single region that they ever have, which we know is the US. And outside a very small window in 1899, I know you're
We started in 1800, so 1890.
Yeah, exactly.
Not that far back.
Yeah, we're really accelerated. Let's move 100 years forward.
Yeah.
But in a great concentration in a narrower cohort of stocks, this is the 10 largest equities accounting for such a large percentage of the overall index in the index that people own the greatest amount of ever.
Yes.
Okay. So from that perspective, in perpetuity, every incremental new dollar into any equity anywhere around the world, $70 per 100 would need to keep going into the US forever just for that to be equal. Okay. In perpetuity. So right there, I think intuitively, like, well, that's a good argument. That means I should be allocating less than $70 to the US going forward.
Yeah.
In aggregate. This is the second reason. I mean, we're a numbers over narrative. This, I would highlight, tells you absolutely nothing about what might happen for the next quarter. I mean, you're looking, as it happens, we could have used a whole range of different valuation measures here, but we're looking at the starting Schiller PE, and you can see across the side there, your starting PE with what your subsequent returns are.
Yeah.
And you can see on the far right of this exhibit that it has traded more expensive. So if we sit here in a year's time and say, look, the Schiller's gone up to 40, yeah, that can happen. Of course it can. It doesn't change the fact that you're just simply taking more of your future return, and it just makes it more negative point to point on that long-term journey. So the point here is the longer your outlook, the less equity you should have exposed to the US market. Plain and simple. So the incremental dollar should be looking in aggregate, in terms of asset class. We showed that all those asset classes have never been more expensive. So you're looking for risk premiums that are not especially compressed. So you might be looking at, emerging market debt. You might be looking at certain regions within equities that are much cheaper. You might be looking at certain assets that in paper terms have actually got cheaper and cheaper. And I know that we'll talk about that a little bit, but certain real assets have actually got cheaper per unit of equity. But what you don't want to do in terms of your incremental new dollar is put it in the area which the numbers tell you will not generate you a good long-term return. Otherwise, you're backing yourself to be able to have a good timing element. And history is littered with people who thought they had a good timing element and didn't.
Sure. And I think the takeout, you in the investment deal often say you're not forecasters by any means, but keen students of history. And I think within a band of reasonable outcomes, maybe that new dollar has a challenging next 10 years.
Yeah, 100%. I mean, what's interesting, if you've highlighted on that, the very far right there, you talk about the dot-com peak in December 99. I mean, in nominal terms, the S&P took about 13 years to get back to that level. So there is periods where, that shows that the valuation kind of really mattered.
Yeah.
Like it took you a long time in nominal terms to just get back to where you were if you were buying the tracker, right? So, disregard starting valuation at your peril would be my advice.
Yeah, that's a good segue. Capturing all of these tectonic plates, the question often then is, well, how do you respond?
Yeah.
You've digested all this information, thinking about all of these moving pieces. Maybe a summary on the playbook.
Sure. So in big picture framework, what we like to think about is sentiment, positioning, and valuation. So listen, we touched on valuation. I think 70% of world market capitalization is positively correlated with yield. So it's effectively saying that the last 30 years of this disinflationary force is likely to persist in perpetuity. Mm-hmm. And I'm positioned accordingly in the equity market. Much better in our view is with that all else equal pressure on the cost of finance and likely higher rates, all else equal, you want to actually have shorter duration. And that's precisely where the market is not. Shorter duration, obviously value as a factor is a good simple shorthand for that within equity markets. That's about the 90 or about the second percentile of cheapness if you look at the last period. So there is a lot of short duration assets that are attractively priced to give you a great absolute return. And also are set to benefit or insulate yourself from a risk perspective to some of the things that I've suggested may well be issues for the global economy as we move past this era of globalization. I think the second thing I'd say in terms of short duration is it's also the kind of assets, if you think about this era of globalization where, many industries have been subjected to increased global competition, and that's driven down the marginal cost of production. It's driven down the overall returns, and the incremental capital that's gone into them has obviously got lower marginal returns. So asset intensive kind of metal bash. So I guess the easy one to think of is that Europe has had a defense industry for as long as I've been invested in equity markets. But, if you look back all that period of 1994 to today, these are manufacturing assets that have been there all that time. In this era of globalization, less and less spend and so on. And then suddenly, as we've started to see a recognition about regional and national priorities, the perception of the value of those assets has changed tremendously. Right. So, we were chatting on the around the desk recently. We don't own it, by the way, but something like nothing in the world moves without ball bearings. So there's a Scandinavian ball bearing manufacturer, for example, got about 60, 65 manufacturing plants. That's been subjected to global competition, the entry of particularly China into the global manufacturing footprint. The incremental returns we've seen from those businesses have gone lower, and, the price that the market's prepared to pay has gone lower. Now, in a world where suddenly you want local supply chains, you want regional or national champions, it wouldn't be out of the realms of possibility to see a reassessment that the incremental returns now to that kind of business will go higher. Yeah. And of course, in a slightly higher inflation, all else equal, the replacement cost of those manufacturing plants goes up. So you're trading well under book value, and it sort of goes up. So that's what I really think about in terms of short duration. I think the second key thing, we've talked very simply about, this is the fight for capital, whose money goes where. So I think you really want to focus, and this is not only in equities, but everywhere, you want to focus on the really well capitalized, strong balance sheets, those that can self-finance, because that's going to be a huge competitive advantage. It always is a competitive advantage, but remains, and I think we'll get an incrementally bigger competitive advantage, particularly as you see a reversal from that low that we showed in the jaws. The third thing that we talk about, I kind of got mixed feelings about this, real assets. So there's a whole range of things that are able to actually produce things that people consume, that have got cheaper and cheaper in terms of a unit of S&P or equity, for example, or fiat assets. So you think about, farming land in certain parts of the world. You think about certain commodities that are non-negotiable requirements for our economy and way of life, but also kind of energy and so on. Real assets, I think, have a very interesting role to play in the world that I was suggesting could well start to transpire over the next period of time. One of my anxieties around that, of course, is that where the debt resides in the world is governments. You've heard me say governments always get paid. The issue with real assets is they're stranded. I mean, we're sitting here in Victoria today. I mean, if you've got a rental property, the government effectively in Victoria anyway has taken on way too much debt, and now they're charging that second. It's got a stranded asset in terms of your rental house or apartment, and now the charges have gone up very significantly. And so that's the risk in terms of real assets, is that governments can change taxation and policies around that to take more of the return for themselves. But then, listen, we always say this, but I think it's particularly true today, given the ownership and concentration that we know. Diversification, look for different return types, but also look for different regions and different types of assets to make sure that the portfolio that you own and speak for on behalf of your clients has a real benefit of diversification, so you're not taking on effectively this risk that you are going to continue to see a widening jaws, and that the last 30 years is indicative of what we're likely to see over the next period of time.
Hey, thinking about this playbook and how it manifests ultimately in the decisions you make for building the portfolio, perhaps a bit of a view. Let's think about the holdings and the attributes of the portfolio, if you will.
Yeah, absolutely. Okay, so that I like to look at the portfolio as a single security. So the portfolio we own on behalf of our clients, it's like a holding company structure, and then we can have a look at the opportunity set. If you index sales to 100, and then you can look at everything like for like. So I think, listen, I just highlight the same three things that we did in the last webinar, actually, which is firstly that debt. You can see the total debt to total equity is a lot lower, so 56% to 124%. So, much better capitalization, but also just the absolute level of debt you can see is $32 versus 94. So the absolute requirement for refinancing, the absolute requirement to get savers capital to be able to run their business is much, much lower.
Yep.
So I think that's super important. I think the second key thing is the profitability. So you've heard me say before, we have the highest quality portfolio that we can afford. So very commensurate quality there in terms of, returns and so on, be that ROE, EBIT over total capital. But really in terms of the playbook, not surprisingly, given our bottom-up value approach, the portfolio is simply materially cheaper than the market. I mean, it's actually at the highest discount that we've seen.
Okay.
At a 41% discount to the market. I mean, let's just use PE, 11.8%. The reality is that everything we do is off the cash, 8.5%, that really doesn't need to grow, is the reality. As long as it doesn't shrink, you're able to actually generate very consistently the kind of returns that we have over the last, say, 5 years or 3 years or 1 year. So much shorter in duration in terms of that payback period, as you can see. So despite paying back more to shareholders, you just got a lot more money that you can reinvest at these double-digit rates of return. So really no change to the portfolio characteristics. The only thing is it's actually got relatively cheaper. I just maybe one thing on the portfolio as of today, it's worth saying, listen, it's always been at a discount. I mean, it's averaged about a 15% discount to the market over the last decade. It's at a 41% discount now, as I said.
Yeah.
But it's actually growing top and bottom line earnings faster. If we owned the same portfolio today over the last 10 years, those companies would have grown faster both at the top and the bottom line. And yet, I think that's underappreciated as well. So you're not foregoing growth in the portfolio. You're just simply getting a portfolio that is materially cheaper. Yeah.
Now, conscious that our sector and regional allocation is always a function of all the bottom-up work you and the team do to build a concentrated portfolio. Perhaps some items to kind of call out as to those exposures.
Yeah, well, I mean, we showed the starting valuation in the US. No surprise. I mean, on the right-hand side there by region, the US explicitly, so there's the asterisk there, would be about 32% of capital overall of our clients. So that 39 includes any ADRs that we have. A bit of a change. We've kind of exited a couple of positions in Japan. Those of us sort of, with us for a long period of time would have seen that peak, in the mid to high teens there a period ago. That's down to about 3%. So relatively small. So that's probably been the biggest change. Europe, actually UK, that includes Scandinavia, but also kind of Switzerland. So pure Europe is actually quite a bit less than that 33. And I guess just on the sector side, probably want to call out healthcare has been creeping up again. That's partly a function of good performance. So obviously there's been a lot of noise, as you said, in markets. Healthcare sector hasn't avoided that.
Yeah.
The big beautiful bill has reduced the rate of growth in Medicare and government spending, but there is still growth, I should add. But actually every single position of healthcare in the portfolio as of this morning is actually in profit. So that is simply a function of the bottom-up opportunity set. The kind of valuation discounts anywhere from about 14% to about nearly 60% in terms of our holdings there. So actually feel relatively relaxed, albeit, there is a requirement ultimately for the US to spend less on healthcare, which is nearly 20% of GDP. So that's probably the ones I'd call out, conscious of time there.
Absolutely. Well, before we cross to Al for questions, there were a couple of things now. The very first opening slide, I talked about the outcomes that the strategy produces, differentiated source of return, really healthy rates of upside, downside capture, and lower vol. And I think looking at that table, the 1, 3, 5 year, the return being particularly consistent, the volatility being low. No, for those that know us, not necessarily a great surprise, but I was hoping I could unpack with you actually that fourth row, downside capture negative on the 1 and 5 year.
Yeah, that's pretty amazing because obviously our biggest single source of risk still is global equity markets. You can see the beta low, but that's still a beta.
Yeah.
And yet what that's showing is when the market goes down, the portfolio and Talaria over the last 5 years has gone up. I mean, it shows the alternative return source, but also it shows, I think, something that we highlighted in the last webinar. So I'll take you back to that. We had a slide which showed, and we made the point about the basis point risk that the market is taking. And that's really the rubber hitting the road of this concentration within regions, but also within sector that we talked about. And that exhibit from memory we showed
in January, if I remember correctly.
Exactly. Yeah. What we showed is that a day where the market went down nearly 2%, in the S&P 500, 350 stocks went up. Yeah. Okay. 350 stocks that just broadly are not owned, right? Just do not have a particularly, you can see from that example, which we showed in the slide, much of an impact on what the index does. Yeah. So despite 350 stocks going up, the index was down 2%, 1.8, whatever. And that is exactly what we're seeing today. There is less money that uses valuation as a strong part of their process. Yeah. There's no better example of that than obviously the rise of passive, where actually it's the reverse. The more expensive and larger a stock gets, the more money is allocated. And therefore, what we're seeing is that the benefits of value as a factor in and of itself are actually going up in a portfolio sense. So they are becoming negatively, inversely correlated. So we've got these decorrelated source of return from the implementation, which the volatility risk premium, but we're also starting to see this differentiated source of return in simply the style in which we actually choose equities and allocate capital. And that's what's changed and really made a big difference, where over the 5 years, we truly are an alternative source of return when markets go down. For a long period of time, we've been able to generate positive absolute returns in falling markets, but you're seeing that now in a much more magnified way and in a much shorter duration. So you don't need the second lever of returns to compound. You also just get the benefit because the stocks go up.
Yeah. And again, before handing over to Al, you mentioned the playbook. Your fourth item on the playbook was diversification. And I think the great challenge for everyone on the call as allocators of capital is just decorrelating the portfolio. So I would draw out, I think particularly low correlation of the strategy pretty evenly there, 0.32 right through to 0.38 over 5 years. Where the rubber hits the road when genuinely diversifying. People don't talk about diversification being an issue when directionally things aren't going that well.
Yeah, exactly. And listen, just to round out on that, I'm conscious of time and we'll get to the questions, but if you go back to that 10-year chart on the valuations implying low long-term returns from equities, for that to happen, we will see the market transition. Whilst that transition happening, we will get all these benefits. For those of a statistical mindset or a risk mindset, the idea that we would be able to generate a Jensen alpha of 6.5 per annum for 20 years is just, you're just not going to see that. But what you will see is as we transition to that stage of that will hugely be beneficial, those characteristics in terms of correlation and beta, but also that downside capture. And as we go through that, they will stay very, very high and very valuable in a portfolio construction sense. And as we move to whatever world we move to in 5 years, 3 years, 10 years, then it will start to round about, and our downside capture will just become positive, I would think, but very low. That's should happen as we move to that world of 10-year forward returns. But whilst we transition, it will stay this very perverse set of outcomes where the train or Jensen, those and the inverse decorrelated return where we go up when the market goes down, I think will stay in place.
Great. Thanks. Conscious of time, Al.
Thanks, gents. we've got a couple of questions. First up from David Isaacs. How does the US reverse what appears to be a dire balance sheet? And what are the impacts on asset classes as a result?
How does it reverse the asset? Yeah, I mean, ultimately what happens is that there's only three ways to get out of a debt problem. One, grow your way out. Two, austerity. Or three, what's known as financial repression, which is really savers paying for debtors. In this case, private sector savers paying for the governments. Now, the first two are not an option anymore. And so we're going to see a very long period of time, and several of you would have heard me say this before, where I think government bonds will be certificates of confiscation for the rest of our lifetime. So I think what will happen, and we're seeing this now in terms of the pressure that is being applied, however independent a monetary authority is, ultimately they are a political body, and we will see US interest rates be much lower than they should be relative to actually what the rate of inflation or goods and services in the economy. And that's how they'll do it. So from a career risk point of view, you have as little sovereign debt in client portfolios you can get away with. Right. So that's how you do it. Because it will not be funded by this $2 trillion of private sector savings, because governments through macro-prudential, because savers will put their money where they think they get their best return, clearly. But, it would be very easy, for example, imagine if Australia said any domestic, savings, a capital gains tax is 10%, and everything that's outside of Australia is 50%. Well, obviously, quite quickly, you reallocate where you're going to put your savings because everybody's looking post-tax, right? So it's not going to be that people decide not to put it in the US. It's that governments will say, we want to retain that capital for low-cost housing, the energy transition infrastructure and the like. So that's how I think that will happen.
And is there anything more on impacts to asset classes broadly within that?
Yeah, so I think I've talked about the sovereign bond market, which is obviously the biggest asset class in the world. I think what it means is that the only way you're sort of talking about co-opting a kind of yield curve, it means assets outside the US will do better than the US.
Yeah. Right.
All else equal. Yep.
Hey, the option market was pretty. I mean, volatility spiked sort of first quarter of this year, and particularly in April. It seems to have come back down to a lower level again. How is the option market, and how are you thinking about volatility at the moment?
Yeah, thanks very much. Obviously, April was the spike that Lance you referred to, where it went over 50. We were able to take advantage of that and we put about 5% of the portfolio into the market on that day, where the market was down nearly 4%, I think. We were getting great annualized returns of between 19 and 30% with these very, very large buffers. So benefited from that. The demand for options is only going up. Clearly, the reversion of volatility from 50 down has been one of the fastest ever. Last webinar, we showed the length of time in the previous periods where it had gone over 40, how long it took. And it's been by far and away the fastest. And the next fastest was that Chinese devaluation scare, I think we showed. And GFC was like 310 days or something that we showed. So that line, if we showed that again, would be one of the fastest. Listen, the way that I think about volatility is, whilst it shows up in the equity market, it's actually a debt instrument. And what I mean by that is that, equity is that thin slither of hope, or the residual after you've paid all the other liabilities, right? You have to pay, and that's why our process, you've got to pay the pension, of the employees, you've got to pay the remediation settlement, the bonds, the debt, the leases, and everything like that. What's left is what goes to the equity holder. And in a world where there's never been so much debt, we should expect all else equal volatility will be higher going forward, not lower. So I think the outlook for volatility medium term is good, because the whole system is a lot more leveraged.
Gotcha. Yeah. Terrific. I think we've got time for one more from Matthew. In your view, is a dovish Fed chairman, if a dovish Fed chairman replaces Powell after his term ends, will duration sell off and assets need to be repriced?
Well, I think a replacement would mean that ultimately they will need to force people to buy bonds at rates that are not commensurate really with the macro and inflation backdrop to compensate investors, right? What we've been seeing is the term premium is rising. So that what that means is the uncertainty around holding a 10-year bond for what the next 10 years is going to look like. So really we're talking about yields being artificially low, and the compensation that people will require will go up. And I think they will become a less attractive asset for global flows of funds, even if the yield might be lower, but they'll have to keep it lower than it should be. I mean, financial conditions today are easier or commensurately easy before the first interest rate rise, just to put that in context. So I think there's every opportunity to see an undermining of confidence in that 2 trillion of flows.
Yeah, terrific. Thank you very much, gentlemen, and thank you everyone for listening. This session will be available on demand within the next couple of days, and if you have attended, we will send you a CPD certificate also in the next couple of days. Thank you very much for joining, and we look forward to seeing you next time. Cheers.
Thanks very much. Thanks, Al. Thanks you.
Thanks.